Well, good morning, everyone. This is Kathy Tarochione, and this is Ron Surz, the host of today's Baby Boomer Investing Show. Morning, Ron.
Morning, Kath. How are you?
I'm really good. Well, we got a great show today. A lot's been happening with the coronavirus, and we're going to go through some of the things that have affected people. Am I correct? What are we going
Yeah,
to
we,
talk about today?
yeah, we're going to talk about damage control. And so I think everyone knows what the markets have been doing and how terrible this virus is. And this is our sixth show. And I think the buildup, if people are watching this, have the time to go see our previous shows because they really, actually, why don't we launch into the slides, Kath, because I do have some
Okay.
stuff to say about the
Okay.
previous ones, and we'll go there.
Okay.
So this is about damage control and what one of the things, it'd be a shame to waste the pain of what we're going through now. So there are some good things that are coming out of the COVID-19. And I just released an article. It's called "The Good, the Bad, and the Ugly of COVID-19." If you Google it, you'll find it, and it's just gotten a lot of interest and reads. It's not profound in any way, but I think it's a nice overview of what we're going through and where we're likely heading. So on the next slide, Kath.
By the way, I'll put a link to that article in
Great.
this broadcast.
Perfect. Thank you.
You're welcome.
So this is our sixth show. And interestingly, on our second show, we warned boomers that there were 10 things on the horizon. It'd be highly unlikely that at least one of those didn't happen while they were moving from working life to retirement over the next decade. And the coronavirus was one of those. So we were a little bit ahead of that. And then in the fourth episode, we talked about the scandal in retirement savings plans. And so I've included two links here for people who have the access to the PDF or the PowerPoint. But we talked about the scandal and we wrote an article. The second part of today's show, I'm going to do a recap on the scandal because I think we were talking about it and it hadn't yet exposed itself. But this COVID really does expose the scandal, and that's really one of the things that we should walk away from this pain with that lesson. So today I'm going to talk about what's gone on in terms of investing so far this year, and then take a look towards where things are probably heading. So on the next slide, Kath.
Okay, let me add here, Ron, that a link to these slides is already in the description. So if you guys would like to get it, and then you'll be able to get to the articles. Okay.
Oh, great. Thanks, Kath. Perfect. So just a top-level overview of what happened in the first quarter. And before I even do that, let me say things are so volatile and frothy that I was tempted to show you this at the very low end in about March 24th, but I didn't want to get sensational, so I waited until the end of the quarter, and things have since changed since then. So today the market was up 550 points out of the box, and it's getting so weird. But if I look at just the first 3 months, ending at the end of March, all of the equities lost money. So the only, in fact, stocks were down more than 20%, and foreign real estate was the biggest loser, down 27%. The only safe place to be was gold and U.S. bonds. Gold was up about 4. U.S. bonds and Treasury inflation protected securities TIPS were up a little bit. Now, the good news for baby boomers is that they're not all in equities, so that's really good. So we're going to look at how baby boomers invest, and we've been saying almost in every one of our shows that you should look, but I think you're going to find that you're 60% in equities and 40% in bonds. And our fifth show, I think, was explaining why that's become the place to be and the wrong place to be.
Mm-hmm.
But on the next slide, let me just recap that fact. So this is a show for baby boomers, and we encourage you to be aware of how you're investing. And if you're an individual retirement account, the average individual retirement account for a 60-year-old or 70-year-old is 60% in equities. And by equities, we mean stocks and real estate, commodities, things of that nature. And the remaining 40% is in long-term bonds. And long-term bonds are really not very safe right now because their yield is very low. And the low yielding, so the bond prices move in the opposite direction to their yield. So when yields go down, bond prices go up. When yields go up, bond prices go down. When yields are near zero, pretty good chance that they're not going to stay there, that they're going to go up. So long-term bonds are a fairly risky investment. Similarly, 2020 target date funds. So if you're in a target date fund and near retirement, you would be in what's called a 2020 fund. And that's for people who are retiring this year or are going to retire soon, or some have already retired. So this people are retiring around 2020. What we've been advocating, and I've gotten specific before, but I want to get specific again, is that's really too risky for someone who is not going to see a paycheck probably ever again in their life and is relying on their lifetime of savings. So we advocate something more like 80% in very safe assets. In very safe assets, we mean treasury bills and intermediate treasury inflation protected securities, TIPS, and something around 15% in equities or less. And when we talk about equities, we mean really broadly diversified, not just U.S. stocks. And certainly the bonds, even though they are risky for diversification purposes, some allocation to bonds. Now, this is not hypothetical. I have been, by way of full disclosure, and I think we do this every show, I have been running the Smart Target Date Fund Index since 2008, so 12 years of real live experience and management results. And I'm going to talk a little bit about the performance results for the smart funds. And I'm doing that maybe a little bit for a commercial, but I'd like you to see that the long-term track record for target date funds is very surprising. And that is the riskier ones were winning the performance race, but they, for obvious reasons, they lose in situations like this. And the long-term track record is sort of a push. But I'll get to that in a little bit. I want to refresh on the next slide, Kath. I want to refresh our audience on what a target date fund is. So what's going on here is on the horizontal scale, we've got years to retirement. So very young people are on the far left, and boomers are on the far right. And the vertical scale is allocations. So for young people, target date funds are very aggressive, around 90% in equities, with a balance in long-term bonds. And then at around 15, 16 years to the retirement date, my patented design starts to move to defend. And my objective is, and this is sort of a financial engineering, that there's mathematics to do this, amazingly enough. So my design says, whatever you have today, if you're 15 years from retirement, I want to make sure that when you come to retirement that you have at least that amount. I would just really, really want to make sure that you don't lose money. And then 14 years, when you're 14 years from retirement, the same story. Whatever the account balance is, that's the thing I want to protect. So in order to do that, there's this thing called liability-driven investing. And that mathematics leads you to be very, very safe when you come to the date that you're going to retire. So my glide path brings you down to, in this case, the way I'm showing is 5% in equities and 95% in very safe assets, cash. The industry, on the other hand, is far different from my patented design. And they end up at the target date, like I just said a second ago, around 55% in equities, with the balance mostly in risky long-term bonds. So what does that mean in terms of recent performance? So on the next slide, I picked this up from the press. So this particular slide got in a lot of articles in the press. So in just 1 week, the week from February 20th to March 20th, these target date funds that are really popular, the 2020 fund, for people who are about to retire, lost a lot of money in just 1 week. And the three on the bottom here, we're going to talk about some more. They are called the big three. Vanguard, Fidelity, and T. Rowe Price managed collectively 65% of the target date fund assets. That's about $2.5 trillion.
Wow.
It's a lot of money, and they own the industry. And look what they lost in just 1 week.
Wow. Oh boy.
So maybe that's making this a sensational story, but it's a lesson. And for people, boomers on this call who are in a target date fund, we've said this in every show, but I'm going to say it again. You need to look, but there's a good chance that you're in one of these three. And I'm going to say this again towards the end of the show, but you need to get out.
Get out. Yeah. Get out now.
Taking way too much risk. Now, the smart funds that I've been managing are at the top. We were down 2% in that week, which we're not proud of, but it certainly defended quite well. So that shows you how fast really bad things can happen. So it wasn't. So first of all, if you're in a target date fund, you didn't lose what the equity market lost, but you lost a big part of it in just that 1 week. But for the whole quarter, which we're going to show you on the next slide, I'm going to show you all the target date funds. And the way this slide works is on the bars are the performance, and then we're showing the today funds. So today funds are for people who have been retired for a while. So they're like a 2010 fund. Then the 2020 fund is for people who are retiring this year. 2030 fund, people are going to retire in 10 years, and so on. And one of the things you can see is because target date funds do take more risk for younger people, they suffered a lot more of the loss. The smart funds protected somewhat, and most of that is due to the greater diversification in the smart funds. So the industry is pretty much U.S. stocks, or concentrated in U.S. stocks. They do diversify some, but not as much as they could. But for boomers, the story is in the today funds and in the 2020 funds. And there's been surveys that ask beneficiaries, people like you, what would be the worst case loss you want to take when you're near retirement? And the answer is 10%. So you all have told, Mass Mutual and PIMCO have done these surveys. And you said I would really hate to lose any more than 10%. So I'm using that definition of a 10% loss as being excessive risk. So for the first quarter, and this is a short period of time, we got another 9 months to go. For the first quarter, you've already triggered the excessive risk marker for the 2020 funds. The 2010 funds did somewhat better for people who have been retired for a while, but still a pretty dangerous time. Then on the next slide, Kath, before I forget, IRAs probably lost about 13% in the quarter, just using the 60-40 rule. So we've got individual retirement accounts are too risky. Target date funds are too risky. And let's look a little more closely at the big three for the quarter, just to get your arms around. So again, if you're in a target date fund, when you open this quarter statement, if you haven't already, you're probably in the 2020 fund, and you're going to see that you lost more than 10%. If you're with the Vanguard fund, 11, with the Fidelity, you lost 12. With the T. Rowe Price fund, you've lost 14, all of which trigger the 10% threshold. The smart funds, by way of contrast, and here I'm not so much, I feel guilty about using smart, but it's the only thing I've got. Conservative target date funds like smart were down, but they're only down 1.5%. Now, that's a lesson. And again, it's not over yet. The corona is still going to be around, it looks like, for some time, and then coming out of it's going to be quite a hassle too. But the lesson here should not be forgotten like the 2008 lesson was forgotten. That's on the next slide, Kath. So in 2008, the 2010 funds, which was for people who are going to retire in 2 years, so they were almost retired, The 2010 funds were down about 22%. And that really triggered the excessive risk of no more than 10. Smart funds were down about 4.5. Then you can see how the longer dated funds did. It was really bad. But 2008 was only part of the story because the mess really started towards the end of 2007, and it didn't end until February of 2009. So on the right-hand side of that slide, we see that every one of the big three target date funds, where, again, if you're in a target date fund, you're probably in one of these, lost more than 30%. The smart funds lost 8%. That lesson just seemed to go away, and it really created an uproar when it happened. So in 2009, June of 2009, the Department of Labor and the SEC had their first and only joint hearings totally dedicated to how to solve this problem with target date funds. Nothing happened.
Whoa.
Actually,
That's impressive.
the only thing that happened was that target date funds got riskier. So we are sitting here with 2008 in our rearview mirrors, totally forgotten. It's out of view, and it should not have been. Things should have been done. And if it happens again, shame on us. So fool me once, shame on me. Fool me once, shame on you. Fool me twice, shame on me. So now on the next slide, here's the thing about protecting. And by the way, there's a couple of other target date funds that are fairly conservative and designed to protect beneficiaries like baby boomers. But there's only two, actually, two other ones. These graphs are a little hard to read, but let me tell you what they're doing. So what we're showing here is the history going back to the end of 2007 of the value of a $10,000 account. And the top one is the 2010 fund, which was the one that was for people who are retiring in 2010. And the blue line there is the smart funds. And you can see that it defended very well in 2008. And if you had a $10,000 account, you would have been better off than virtually every other target date fund for about 8 years. And then for the next 2 years, this rapid run-up in the U.S. stock market started to bring competitors back into line. And then finally, for the last few years, they did better than the smart funds. But look how fast things changed. In just the last quarter, that red line now is dipping back down to the smart. So I just say this in the simplest way. Even though there were times when you would have preferred to be in more aggressive funds, so imprudent funds were winning for about 7 or 8 years, that all changed in just 3 months. And if things go the way they look like they're going to go, that red line is going to go below the blue and pretty quick. The 2020 fund has a similar pattern, but that was for people, again, who in 2008 were retiring in 12 years. But is today's, the fund for today's retirees. And then finally, the 2050 fund, which is for younger people. This is really surprising. So the smart funds defended somewhat early on because of the diversification. And a similar pattern emerges. And the interesting thing here is that for the full roughly 11-year period we're showing here, it's a push. So there's been a lot of articles written about winning by not losing. If you can avoid the losses and not give up too much when the markets are skyrocketing, you'll do fine. And that's the story here. And for baby boomers who only get to do this once, this risk zone is really important. You can't afford to lose your money now. And the sad thing is you've lost some right now, but there's time to act, and you need to act. So what I want to do for the rest of this, I want to do a quick recap of what we did in the fourth episode about the scandal. So Kath, on the next picture, just going to do a recap. And so I'm going to go through something. I don't want to scare everybody, but
no, go ahead. Go ahead. I think you should.
All right.
Hey.
So in the article, the good, the bad, and the ugly of the COVID-19, one of the things that is happening now is the government is pouring money at the problem. And there's $2 trillion being put out in what's called helicopter money. Everybody gets a check. And isn't that wonderful? Well, maybe at first it will be. There's another $2 trillion being set aside for loans that might not have to be repaid. In fact, I think most people are taking those loans out, think they'll never repay them. And the conditions are pretty simple. If you use the money to pay employees and so on, that's $4 trillion. That's on top of $5 trillion that has already been put out in what's called quantitative easing. So $9 trillion is about 40% of GDP. I don't know even how to say this anymore. We are in deep doo-doo, and the way it's likely to work is there will be inflation. And I just heard a commentator on Fox News yesterday going, it's unavoidable now. It's done. This is done. We're going to have serious inflation. But what that does is it causes interest rates to rise, because if you can't at least get inflation on your investments, you're going to try to seek other ways. In fact, gold is probably a place that's going to thrive. When interest rates rise, it triggers this thing called a debt spiral. And the US and other major countries like Japan and China to some extent can right now just barely afford to pay the interest on their debt. If interest rates go up, they won't be able to afford that. So the COVID-19 is going to go away, but the debt spiral won't. And it may take a year, 2 years, but the wheels are all in motion now. There's no backing up. This train is rolling down the track. So the scandal that I talked about before becomes even more critical, and not just for this quarter. So on the next slide, Kathy, I just want to remind people that there was a scandal, and it's sort of gotten resolved. So the first scandal in retirement plans was excessive fees. And there were books written and TV shows, and nothing happened. And it sort of reminds us that there are carrots and sticks. The carrots are to do the right thing. And if these shows had an impact, the fiduciaries would have started looking, and the book told people where to look. Here's where the excessive fees are, and go fix them. But nothing happened. What did happen is on the next slide. There's this attorney called Jerome Schlichter who's made a fortune on class action lawsuits for excessive fees. And that now solved the problem. So over the last 3 or 4 years, the emphasis has been just get the fees lower, get the fees lower. So target date funds have gone from around 100 basis points for the average fee down to 60 basis points. So it worked, but it's not the carrot, it's a stick. So on the next slide, some have said, and I'm thinking it's possible, but I'm not sure how bad it needs to get and how obvious it needs to get, that the way to solve this excessive risk thing is for another champion attorney to come and start suing people. And the excessive fee thing is really important. And just on the next slide, and we talked about this in our previous shows quite a bit, but every one of us has a time in our life when we invest, we know that there's a risk of loss. That's just part of the game. And the more aggressive we are, the bigger the risk of loss. But that risk of loss turns into something much more serious as we're transitioning from working life to retirement. And that's during the risk zone. That red line there is our savings. So our savings have peaked. And if all of a sudden, like 22% loss in one month takes 22% of our savings out, we got
and it's gone. That's it.
It's gone. We got 22% less to spend and all that. You can argue that it's going to come back. It might. Nobody knows about the COVID-19, how long this is going to take. And I really do think this debt spiral's out there. So whether you will come back or not, this is problematic. And there's this thing called the sequence of return risk, which says even if it does come back, you're going to be spending in the meantime.
Mm-hmm.
And so you won't come back with all of your money. You'll come back with whatever you haven't spent. So it's a very serious risk that is not being acknowledged. 60/40 does not acknowledge that. So the scandal is on the next slide. And the scandal essentially is that people who are choosing target date funds have really breached what's called the best interest standard and their duty of care. The industry has sort of evolved into one that's controlled by just three firms: Fidelity, T. Rowe, and Vanguard. And they're fine firms. And some people have said I've got something against those three firms. They're great. But oligopolies are never good. But what's going on is fiduciaries, primarily consultants, have said, I take too much of a business risk by not using the big three. And there's this thing called procedural prudence that says if you do what everybody else is doing, you're covered. You'll never go to court. But there's a higher standard called substantive prudence, which basically in this case says if I'm doing because I think I have a business risk and I'm willing to expose my beneficiaries to excessive risk, that's breaching a duty of care. So on the right-hand side, we show you how the big three are allocated. And these things are called glide paths. And again, the horizontal scale is years to retirement. And the vertical scale here is a measure of risk. It's your exposure to equities. And you can see that the big three have a little difference. Fidelity is the riskiest for younger people, then T. Rowe, and then Vanguard. And then that flips in retirement, where Vanguard becomes the riskiest. But all three are about 55% in equities. Again, this 60% thing, this keeps on coming up. And that lost a lot of money. The next slide, just to remind you, by the way, there's $2.5 trillion in target date funds and something like $8 or $10 trillion in individual retirement accounts, IRAs. So the IRAs are the bigger issue. And I'm sorry, go ahead, Kath.
Yeah, I want to ask something. Yeah, the question I have is, so why are the financial advisors continuously going and recommending the 60/40?
Well, that was no, it was our fourth show. So our fourth show was about the history and evolution of financial theory and investment consulting. And what's really gone on there, and just I support it with a lot of data and studies and everything else, but at the end of the day, 60/40 was sort of the pat answer when financial consulting started. And it was a pat answer because it's sort of the way assets clear the market. So the best diversification you can get is to own all the assets in their proportion. But what's really going on here is this epiphany. And the epiphany is target date funds. And the epiphany is that people, baby boomers in particular, cannot afford to take risk at a certain time in their life. So the whole notion of a target date fund is you need to not let people take risks. And what goes on is advisors work with their clients and they say, so what do you want to do? And the client says, I want to buy a Lexus, and I want to send my kids to college, and I want to do this and that. And the consultant has tools to figure out what the participant, or I'm sorry, the client needs to earn on his investments to deliver those objectives. And out comes a rate of return. And there's very little recognition yet, this is just starting, that the client might not be able to take the risk that would be required to earn that rate of return. And the jargon is his risk capacity limits his risk needs. So what the advisor should start doing, I think it's starting to happen. There's a fellow named Michael Kitces who has been writing quite a bit about this as well. So what the advisor really should be saying is, hey, big boy, you need to lower your objectives because you can't afford to go for these. You're about to retire. You're going to give up your paychecks. So the 60-40 rule really needs to be a distant memory. Now,
for some reason, it sounds almost like it's been a cookie cutter.
It is
type of approach.
It is, and the models are cookie cutters too. We're going to talk about that, I think, in one of these slides coming up pretty soon.
Okay.
But the alarming thing, and this is a study by EBRI, the Employee Benefit Research Institute. The average account balance for people in individual retirement accounts is 60%, regardless of how old you are. So 20-year-olds, you can sort of understand that. Maybe they should be riskier, probably should be, because if they lose the $100 they've saved, they've got plenty of time to make that back. But for people who are in retirement and about to retire, that's the same 60-40. So
doesn't make sense.
No, it doesn't. So on the next slide, we're going to see what I mentioned the surveys before, and again, we're recapping that episode 4. If you looked in this glide path slide on where the surveys say you should be and compare them to IRAs and the big 3, you can see that fiduciaries or beneficiaries are saying they want to be safe, but they're not. And you see the smart funds are there. So now we're going to start to go into what should boomers do. And that's on the next slide. Now, one of the things that is sad but true, if you're in a target date fund now, you're in a 401k plan, and that 401k plan only has the target date fund available to you that your employer has chosen. So I'm going to reinforce this. If you look and you're where I think you are, 60-40, and you can't get out of your 401k plan, you need to take back your control. Now, you're probably in the target date fund because you couldn't make an election. You've defaulted into it. But think long and hard about whether you really want to stay there. Then the other advantage that you have once you get out of it is now you have control. And the shortcoming of being in a target date fund is just one size fits all. So it's definitely not right for you now. So you need to get out anyway. But one of the benefits is that you get now to control it. And I'm going to give you some guidance on what you do. And so you don't want the excessive risk and everything else we've been talking about, but you do want to take back. So if you go to an advisor, this is on the next slide, just be aware that what the advisor is probably going to use are these models. And we talk about the models in the previous show, and I cut to the bottom line. What they do, they go from left to right, from low risk to high risk, and the returns go from low to high. So the more risk you take, the higher risk you take. There's a lot of gravity towards the middle, and that's the 60-40. So just be careful about that. Using an advisor is a good idea, but just be trust but verify.
Mm-hmm.
So if you do take back control, we have sort of a template on the next slide. And I think the target date fund template is a good one, but takes too much risk when you're about to retire. So the orange line here is the typical target date fund, and there's 3 decision points, A, B, and C. So A is when you're young, and 100% is maybe too much, but this is a starting point for you to think about. Well, you're not there, so never mind. But you are at point B if you're a boomer, and we advocate that you take much less risk. B prime is maybe 10% equities, and then in retirement, you might want to stay safe. If you stay in sort of this glide path idea, there have been studies done that say, stay safe during the risk zone. So stay safe for about 5 years in retirement, and then you can start to re-risk and get back in the market to extend the life of the assets. I will say this, that annuities is something you should give serious consideration to once you're through the risk zone, or other sort of protected defense, like guaranteed withdrawal benefits, things of that nature, things that are designed specifically for you in retirement. But once you take back your control, consider being very, very safe now. And on the next slide, so Kathy, these people can open up the show.
Right.
So what we do here is provide 4 articles that should help. And what they do is they address, I think, what the 4 primary questions on every investor's mind. Simple one, how should I invest? That's a tough one. How can I protect my savings? How can I make my savings last? And now as you told me all that stuff, can you prove it? And the proof statement, by the way, is the track record for the smart target date funds. So I encourage you to open up the slideshow and visit those articles. So at the end of the day, on the next slide, Kath, we really think target date portfolios are a way to go. Certainly if you're an IRA, don't be 60-40 for your entire life. And then on the next slide, move to safety. What you really want to do is protect. You want to build. You want to be cautious of the model approach. And I just want to be clear on this. What the markets were up, again, 550 points today. And I think a big part of that is what's called buy the dip has become the smart thing to do. If you follow my advice, what you probably want to be doing is selling into the increases. So if you started 60-40, the recent decrease in the equity markets has maybe brought you down to 50-50. That's still pretty risky. So what you want to be doing is selling your equities and getting down below, at least below 30% in equities. So that's advice that I don't think anybody else is giving, but it's the only way to get to safety if I'm right about where you started. So a word on the next page about the Corona. I guess I just said that I preempted this slide. So let's go to the next one, Kath.
Okay.
So on every slide the show, we sort of conclude with this, and Kathy and I sort of started the show, and we got together at Christmas time. Kathy's my sister, and I said, "No, I'm really, yeah, I'm really worried about my fellow boomers. There's a lot of stuff that can happen, and I talk to my friends; they'll share everything with me, but I have a sense that they're taking a lot of risk." So we started the show, and I put up a website called Age Sage Robo, where if you do it yourself and you don't want the help, you feel comfortable doing it yourself, visit that website, and it will give you, if you tell me some things about yourself, it'll give you an asset allocation. And you'll pay a little bit for that, but I'm not giving
a little bit. It's $50, folks.
Yeah.
$50. Who wouldn't want to do that?
Yeah. And the other thing, if you have a consultant, you can do it to trust but verify. If you want to use a consultant, we have a website called Glide Path Wealth Management, and that will help you find a really good consultant. We work with Janney Montgomery Scott, and that's encourage you to look at that. On both websites, there are free, really good free stuff. So ebooks and learning and
Articles and
a lot of really good stuff. So I encourage you to do that. And then please watch our Baby Boomer Investing Show. I think, Kath, our next one, I'm not sure about the timing on this, but with all the things that are going on, if something really interesting happens, we won't have a guest. But if we do have a guest, I think we'll invite somebody to talk to us about reverse mortgages.
okay.
And I only think about that because some of our listeners may have a lot of equity in their house and be thinking they'll sell it, to move on and downsize and things like that. There's an option there, and we'll just we might talk about that on the next show. The last slide is a slide we normally don't do. And it's a slide for if we have fiduciaries on this call or plan sponsors. You guys can read the things here, but for you, I just have a very simple message. And I would say the best fiduciary protection is beneficiary protection. And even though the big three are just fine firms, they are not providing beneficiary protection for my fellow boomers. And I guess we'll end there.
Okay. All right. Well, that was whoops. We'll get rid of that. That was an excellent show, Ron.
Thanks. Well, just again, I think I keep looking at the shows that we've done so far, and they're building and building. And they set. One of our things was about the 4 pillars of smart investing. So I think we set the pillars and the basis and the foundation for our fellow boomers to. I think they need to protect themselves.
Right. Okay, so why don't we recap? So now people that do have a target date, they should go ahead and look and see if they're got the 60-40, right?
Yep.
And actually, they should really just pull out.
They're probably going to be 60-40. I mean, it's highly likely. Yeah.
Okay.
And if they're an IRA, which, so again, about 5 times as much money in IRAs as target date funds. So pretty good chance our listeners are in both. So pretty good chance that they're 60-40 in the IRA too. But that one, they already control. They haven't defaulted. It's just their money to move around.
Yeah, right.
So that one's a little simpler.
Okay, well, that was an excellent show. We'll see you guys in 2 weeks. And thanks for watching.
Thanks, Kath.
Okay.
Bye.